You're holding SCHD, solid, reliable, a dividend investor's favorite. But that nagging feeling creeps in. Am I missing out on growth? Could my income stream be smoother? SCHD is great, no doubt. But to really level up, it takes more than just one piece of the puzzle. That's where these two additional moves come in to help you and Alpha build a portfolio that isn't just collecting dividends, but also optimized to generate a monthly income of $5,200 from an initial $10,000 investment. Today, we're diving into a simple yet powerful portfolio strategy that can take your dividends to the next level. First, we'll lay the foundation with SCHD, why it's a dividend machine and a must-have for any income investor. Then, we introduce two missing pieces that can make this portfolio even stronger. One ETF will supercharge growth with a massive 26.86% dividend growth, while the other will deliver stable income with a 6.98% yield, even in a volatile market like this year. By the end, you'll see exactly how this strategy builds a rock-solid portfolio that thrives in any market while putting serious cash in your pocket. Let's get into it. Why SCHD remains a compelling buy? Straight away, let's talk about why SCHD is an absolute powerhouse for a retirement portfolio. If you're serious about building long-term wealth with dividends, this ETF is a no-brainer. Now, what makes SCHD's strategy so solid? It's all about quality over hype. It screens for companies with at least 10 years of dividend payments. That's right, SCHD isn't chasing hype stocks, it's stacking proven winners. You've got Lockheed Martin, a defense giant with government-backed revenue, AbbVie, a pharmaceutical powerhouse, and BlackRock, the world's largest asset manager. All three leading the charge. It also holds Coca-Cola, Home Depot, Texas Instruments, and some other strong names that matter. When it comes to dividends, SCHD isn't just picking stocks like someone blindly grabbing snacks at the grocery store. It does its homework, checking cash flow, return on equity, and debt levels to make sure these companies can actually keep paying up, rain or shine. That's why SCHD is packed with industry giants, companies that dominate their sectors, rake in profits, and most importantly, treat investors like us very well. And let's talk about balance. SCHD isn't just loading up on one hot sector and hoping for the best. Financials lead the way at 20%, which makes sense because banks, asset managers, and insurance companies know how to make money off money. Then you've got industrials at 15%, bringing in that steady blue-collar cash flow, and technology at 14% to keep things growing. But here's the real magic: consumer defensive and healthcare. People need these companies no matter what. Medicine, food, household essentials. That's why SCHD doesn't just survive market downturns, it shrugs them off like they're nothing. Now let's run through the metrics. With a solid 3.79% dividend yield, SCHD is guaranteed to provide solid passive income. But the real magic is in its 12.21% annual dividend growth. What this means is that your payouts keep increasing year after year. On top of that, SCHD's share price has historically grown at 10.21% per year. So your investment isn't just paying you, it's growing too. This is why SCHD is the foundation of our retirement strategy. Right now is still a great time to be buying SCHD. Dividend stocks are getting a boost from lower inflation and a drop in long-term interest rates, both of which make high-yield investments like SCHD even more attractive. On top of that, many of SCHD's holdings are set to benefit from the rise of AI, improving everything from supply chains to production and marketing efficiency. The market hasn't fully priced in these advantages yet, which means SCHD could be an undervalued opportunity in a changing economy. For investors looking for strong dividends with solid growth potential, this is the kind of setup that doesn't come around often. Overall, SCHD is an incredible ETF, but it's not perfect. There are two major sectors it's underweight in, and in today's market, that's a big deal. What SCHD could have missed? So you and Alpha have been sitting there, sipping on your SCHD coffee, thinking, something's missing. And you'd be right. Where's the sugar and milk? Where's that extra kick? Well, in SCHD's case, that missing flavor comes from technology and utilities, two key sectors it seriously falls short on. Take technology, for example. SCHD does have some exposure, around 15%. With AI reshaping the economy, SCHD's dividend-focused strategy means it's missing out on some of the biggest players in the space. It's like showing up late to the party, and all the good snacks are already gone. Sure, what's left is still decent, but wouldn't you rather have the full experience? Let's put it this way. Because SCHD focuses on dividend-paying stocks, it doesn't include many of the biggest growth drivers in tech, like Nvidia, Amazon, or Meta. Instead, it leans toward more established and slower-growing dividend payers, like Cisco and Texas Instruments. Then we have another gap in utilities. These companies own the infrastructure AI depends on, like power grids and data centers. Yet, SCHD has almost no exposure to them, just only 0.37%. As AI adoption skyrockets, demand for electricity and data transmission is only going to increase, meaning this sector is primed for serious long-term gains. I know that might sound a little concerning, but don't worry, there's an easy fix. Stick with us till the end and we'll show you and Alpha exactly how to supercharge your retirement portfolio. JEPQ. First up, let's talk about JEPQ, the ETF that's bringing some much-needed tech power to Alpha's portfolio. Think of it like adding Wi-Fi to your old-school TV. It just makes everything better. JEPQ gives you exposure to two of the big dogs of tech through the NASDAQ 100, but with a twist. It also runs a covered call strategy, which means it collects extra income by selling options on those stocks. In other words, JEPQ isn't just sitting around hoping for stock prices to go up. It's out there hustling, collecting premiums like rent money from the market. And when it comes to sector allocation, JEPQ leans hard into tech. We're talking Apple, Microsoft, Nvidia, Amazon, Alphabet, the kind of companies that don't just ride trends, they create them. If SCHD is your reliable dividend-paying grandpa, JEPQ is your cool cousin who just landed a six-figure tech job and somehow still wears hoodies to work. Alright, let's talk numbers. By offering a massive 10.71% dividend yield, JEPQ is an income powerhouse, way higher than your typical stock market investments. And the secret behind that high yield? Covered calls. Instead of just sitting on tech stocks, JEPQ sells options on them, bringing in extra cash that gets passed down to investors as dividends. But here's the trade-off. While you're raking in that sweet income, the share price growth has been pretty modest, historically around 1.91% per year. Now, why are we adding it to our portfolio? Simple. Tech exposure with cash flow. We already love SCHD, but it doesn't go heavy on tech. JEPQ fills that gap, letting us tap into the upside of giants like Apple, Microsoft, and Nvidia, while still getting that reliable income stream. So with JEPQ, we've locked in solid tech exposure while keeping the cash flowing. But there's one more missing piece: utilities. That's where our next ETF comes in. UTG. UTG, as the last piece of this puzzle, is the secret weapon for stability and income in our portfolio. While SCHD and JEPQ bring dividend growth and tech exposure, UTG gives us something just as important: steady, recession-resistant cash flow. UTG is all about utilities and infrastructure, investing in companies that keep the lights on, the water running, and the internet flowing. Think power grids, telecom networks, and everything that makes modern life possible. These are the kinds of businesses that people rely on no matter what's happening in the economy, which makes UTG a rock-solid choice for income investors. Now let's talk about what's under the hood. UTG is heavily weighted in utilities, with major players like NextEra Energy, Dominion Energy, and Duke Energy leading the charge. But it's not just about power companies. It also holds telecom giants like Verizon and AT&T, because, let's be real, the modern world runs on both electricity and internet connectivity. This mix of essential services and steady cash flow is what makes UTG such a unique addition to our portfolio. On the numbers side, UTG brings in a healthy 6.98% dividend yield, meaning you're getting solid income from the start. When it comes to dividend growth, it's there, but modest, at just 1.11% per year. And when it comes to share price appreciation, it's not exactly a rocket ship, averaging 0.37% per year historically. But of course, that's okay, because for our strategy, UTG is meant to be the perfect complement to the higher growth, higher risk parts of our portfolio. So with UTG in the mix, we're covering all our bases: SCHD for dividend growth, JEPQ for tech and income, and UTG for steady, recession-proof cash flow. Now let's see how all this comes together into a retirement-ready dividend machine. Portfolio: SCHD 50%, plus JEPQ 25%, plus UTG 25%. Alright, here's how we bring it all together into one powerful income-generating machine. SCHD is going to be the backbone of our portfolio, taking up 50% of our allocation. Why? Because it's a proven dividend growth beast with solid price appreciation, making it the perfect foundation for long-term wealth building. But we're not stopping there. To boost our yield and diversify our income sources, we're adding JEPQ with 25% for high-yield tech exposure and UTG with 25% for stable, recession-resistant utilities. This combination gives us the best of all worlds: growth, high income, and stability. Now let's break down the numbers. Together, this portfolio delivers a 6.38% dividend yield, meaning we're getting strong income right from the start. Dividend growth sits at a solid 13.1% per year, ensuring that our payouts keep climbing over time. And in terms of price appreciation, we're looking at a respectable 5.68% annually. So not only are we collecting dividends, but our portfolio is growing in value too. This is where things start to get really exciting. Imagine kicking things off with just $10,000. At first, it might not seem like much, but give it 5 years, and you're already pulling in $1,100 per year in dividends, with your portfolio growing to around $18,000. Not bad, right? Now fast forward 20 years and things get even better. Your portfolio has ballooned to $138,000, and your annual dividend income has jumped to a solid $10,600. That's passive income rolling in year after year just for holding this portfolio. But here's where the magic really happens. At the 30-year mark, your dividends explode to $62,000 per year. That's over $5,200 a month. And your portfolio? A jaw-dropping $678,000, all from a simple, well-structured ETF portfolio that does the heavy lifting for you. And there you have it, the ultimate retirement portfolio built for both growth and high-yield income. SCHD lays the foundation, but adding JEPQ and UTG takes it to the next level, filling in the gaps and maximizing your dividends. This strategy isn't just about building wealth, it's about creating a financial engine that pays you for life. So we want to hear from you. Drop a comment below and let us know which ETFs you're holding in your portfolio. Got a favorite? Let's talk about it. We'll dive into your suggestions. In the meantime, check out these other great investment ideas. We've got something for everyone.